You sit down at a heavy oak desk, sign your name on a mountain of complicated paperwork, and quietly commit the next 30 years of your life and hundreds of thousands of dollars to a bank. It feels entirely normal. For most of us, securing a 30-year fixed-rate mortgage is treated as the ultimate rite of passage into adulthood. It is the undisputed gateway to the American dream, a financial inevitability we accept without a second thought. But what if I told you that this specific financial instrument isn't a natural law of economics? What if I told you that for the first century and a half of American history, the 30-year mortgage simply did not exist? Before 1934, trying to buy a house was a terrifying, high-stakes gamble. It required massive amounts of upfront cash and forced buyers into incredibly dangerous, short-term debt traps. It actually took the greatest economic catastrophe in human history to invent the system you are participating in right now. So, how did a generation of people without modern banking ever afford to buy homes? And why did the federal government suddenly decide to put you in debt for 3 decades? If you were living in America before the 1920s and you wanted to buy a house, you essentially had 2 options. You either had a massive pile of physical cash, or you simply didn't buy a house. It was really that brutal. Home ownership was an incredibly exclusive club, mostly reserved for the wealthy elite, or for farmers who built their structures by hand on generational land. The national home ownership rate hovered stubbornly around 40%, meaning the vast majority of the working and middle class were permanent renters. Banks back then had absolutely zero interest in lending money to average people for something as illiquid and risky as a family home. Commercial banks preferred lending to businesses, railroads, and industrial tycoons. Giving a 25-year-old factory worker a loan to buy a cottage was considered terrible business. So, regular people had to get creative. Enter the building and loan associations. To understand how these worked, we have to look at the very first one in America. The Oxford-Provident Building Association, founded in 1831 in Frankfort, Pennsylvania. Imagine you and 30 of your neighbors all want to buy homes, but none of you have the capital. You all agree to meet at the local tavern once a month and chip in a portion of your monthly wages, say $3, into a collective pot. Once a year, when the pot grew large enough to fund the construction of a single home, the group would literally draw lots or hold an auction to see who would get the lump sum that year. It was a communal lottery system. The winner got to build their house, but they had to keep paying their monthly dues into the pot until every single member of the association had their own home built. You had to be incredibly patient, trusting, and deeply embedded in your local community. If your name wasn't drawn in the first few years, you just kept renting and kept paying into the pot, hoping next year would be your lucky break. There was no instant gratification. There was no clicking a button online to get pre-approved for $500,000. You saved, you pooled resources with people you knew by name, and you waited. The entire culture of the 19th century viewed debt not as a tool for financial leverage, but as a deep moral failing. Being in debt meant you were living beyond your means, a character flaw that society frowned upon heavily. Cash was undisputed king. If you couldn't pay for the bricks, the lumber, and the labor outright, you didn't get to lay the foundation. This hyper-local, cash-centric system worked fine when America was a predominantly agrarian society. But things were about to change drastically. As the nation began to industrialize at breakneck speed in the late 1800s and early 1900s, cities swelled with millions of new factory workers and immigrants. This slow, neighborly system of passing around a collection plate at a tavern simply couldn't keep up with the exploding, desperate demand for urban housing. People wanted homes, and they wanted them now. They didn't want to wait 15 years for their name to be pulled from a hat. The sheer volume of people moving into places like New York, Chicago, and Detroit created an unprecedented housing crisis. Entire families were crammed into tiny, dangerous tenement apartments. The pressure cooker of urbanization was building, and the financial sector finally smelled an opportunity. Banks realized there was an ocean of potential profit to be made off the working class's desire for home ownership. But because the banking system was entirely unregulated and highly predatory, the solution they came up with was essentially a financial death trap. They were about to introduce the American public to the mortgage, but it looked absolutely nothing like the mortgage you know today. It was a product designed to maximize bank profits while placing 100% of the catastrophic risk squarely on the shoulders of the borrower. For the average family, renting wasn't just a temporary stepping stone, it was a permanent state of existence. Landlords held immense power, and leases were heavily weighted against the tenant. You could be evicted on a whim if the landlord decided to sell the property or raise the rent beyond your means. The desire for a permanent sanctuary, a place where you couldn't be arbitrarily thrown out onto the street, was a driving psychological force. Yet, the barrier to entry remained insurmountable. If you wanted a $4,000 house in 1910, you needed $4,000 in your bank account. There was no such thing as an amortization schedule. There was no such thing as a credit score. Your character was judged by the calluses on your hands and the cash in your pocket. The banking establishment viewed the working class as a liability, completely unworthy of institutional trust. But as the 1920s approached, the intoxicating allure of consumer capitalism began to rewrite the rules of American society, setting the stage for a disastrous financial experiment. And this is where it gets interesting, because the banking industry finally stepped into the housing market during the Roaring '20s. But they did it in the most dangerous way imaginable. They introduced something called the balloon mortgage. If you think your current mortgage is stressful, take a second to imagine this reality. It is 1925. The economy is booming. Jazz is on the radio. And you want to buy a modest home in a rapidly growing city. You walk into a bank, and they agree to give you a mortgage. But right off the bat, they demand a 50% down payment in cash, half the entire value of the house, right up front. If you somehow manage to scrape together that monumental sum of money, the terms of the actual loan were terrifying. The mortgage only lasted for 3 to 5 years, and during those 5 years, your monthly payments only covered the interest. You weren't actually chipping away at the principal balance of the house at all. You were essentially just renting the money from the bank. Then came the nightmare. At the exact end of year 5, the entire remaining balance of the house became due in one massive lump sum balloon payment. Obviously, almost no one could afford to drop the remaining 50% of a house's value in cash on a random Tuesday. The entire system relied on a very fragile psychological assumption that when the 5 years were up, the economy would still be booming, property values would still be rising, and the bank would simply smile and agree to refinance the loan for another 5 years. It was a perpetual cycle of short-term, high-anxiety debt. You never really owned the house. You just continuously bought 5-year extensions on the illusion of ownership. Because coming up with that initial 50% down payment was mathematically impossible for most families, a shadowy and highly predatory secondary market exploded. Buyers who had maybe 10 or 20% in cash would take out second or sometimes even third mortgages from private lenders. These weren't reputable banks. These were aggressive private brokers charging absolutely extortionate interest rates, sometimes as high as 8 to 10% in an era with virtually zero inflation, just to cover the down payment for the first mortgage. The typical American homeowner in the late 1920s was standing on a precarious house of cards. They were juggling multiple short-term loans, paying only interest to several different lenders, and praying every single night that the bank would pick up the phone and agree to refinance when that 5-year balloon inevitably popped. It was a financial time bomb wired directly to the foundations of millions of American homes. Let's look at a specific scenario to understand the sheer terror of this setup. Imagine a man named Thomas, a mid-level manager in Chicago in 1926. He buys a home for $5,000. He puts down $1,000 of his own savings. He borrows $1,500 from a shady second mortgage lender at 9% interest and gets a primary 5-year balloon mortgage from the bank for the remaining $2,500 at 6% interest. For 5 years, Thomas is bleeding cash just to cover the interest on both loans. He hasn't paid down a single penny of the actual $5,000 cost of the home. As 1931 approaches, his balloon payment is looming. He needs the bank to refinance that $2,500, or he has to produce it in cash. If he can't, the bank takes the house, and he loses everything: his initial $1,000, all the interest he paid, and the roof over his family's head. This system was fundamentally flawed because it assumed permanent economic prosperity. It required the banking system to be perpetually willing and able to lend money. It treated homes not as long-term family assets, but as short-term speculative financial instruments. The banks loved it because they collected steady interest and held tremendous leverage over the borrower. If the borrower defaulted, the bank just seized the property, which they assumed would always go up in value. But what happens when the music stops? What happens when a localized system of debt encounters a global, systemic collapse? The 1920s were a facade of wealth built entirely on fragile credit. And when that credit dried up, the balloon mortgages didn't just pop. They took the entire American working class down with them. That ticking time bomb finally detonated in October 1929. When the stock market crashed and the Great Depression swallowed the global economy, the music abruptly stopped. Banks were suddenly bleeding cash, suffering from massive runs as panicked citizens tried to withdraw their life savings all at once. The banks desperately needed liquidity to survive. They needed physical cash in their vaults, and they needed it immediately. So, when those 3 to 5 year balloon mortgages naturally came up for their routine renewal, the banks did the unthinkable. They said no. They refused to refinance. They called in the loans. Imagine being a father in the brutal winter of 1931. You've never missed a single interest payment in 5 years. Your term is up, so you walk into your local bank branch expecting to sign the usual extension paperwork. Instead, the teller coldly informs you that the bank is calling the loan. You have 30 days to hand over the entire cash value of your home, or the sheriff will be sent to evict you. It was a mathematical impossibility. Unemployment was skyrocketing toward 25%. No one had cash, let alone thousands of dollars lying around. The results were catastrophic and deeply traumatic for the American psyche. By 1932, the American housing market had completely collapsed. Property values plummeted by over 50% in some areas. This meant that even if a desperate family tried to sell their home to pay off the bank, they couldn't get enough money to cover the outstanding debt. They were trapped in negative equity before the term even existed. At the darkest depths of the Depression, a staggering 1,000 families were losing their homes every single day. 1,000 foreclosures every 24 hours, tearing through neighborhoods like a financial plague. You would walk down the street in cities like Cleveland or Philadelphia in the dead of winter and see entire lifetimes of furniture: beds, dining tables, family portraits, children's toys, thrown carelessly into the snow on the sidewalk. The local sheriffs and police departments were so overwhelmed with eviction orders that they could barely keep up. In some towns, neighbors formed anti-eviction mobs, standing on the porches of foreclosed homes with baseball bats to physically prevent the banks from taking the property. The private banking system had proven wholly inadequate and fundamentally destructive. The standard rules of capitalism had failed completely. The government's initial response, under President Herbert Hoover, was to essentially do nothing. The prevailing political philosophy of the time was that the federal government had absolutely no business meddling in private contracts or local real estate. Housing was considered a purely local issue, a transaction between a private citizen and a private bank. The government believed that the market just needed time to correct itself. But this wasn't a standard market correction. It was an economic death spiral. As the foreclosures mounted, a vicious cycle accelerated. Banks ended up owning thousands of empty, depreciating houses that they couldn't sell because no one had money to buy them. Because the banks held these toxic assets, they couldn't lend money to businesses. Because businesses couldn't get loans, they fired more workers. Because more workers were unemployed, more people defaulted on their balloon mortgages, leading to even more foreclosures. The system was eating itself alive. Hoover did attempt one minor fix in 1932 by creating the Federal Home Loan Bank System, which was designed to lend money to the banks so they could in turn lend to homeowners. But it was a catastrophic failure. The banks took the government money and hoarded it to pad their own balance sheets, refusing to pass the relief down to the desperate citizens facing eviction. It was a classic trickle-down solution to a problem that required a bottom-up rescue. The American people were losing faith not just in the banks, but in the very concept of capitalism itself. Revolution was whispering in the wind. The nation needed a savior, or at least a completely new set of rules. With the fabric of society unraveling, bread lines stretching around city blocks, and makeshift Hooverville tent cities popping up in public parks across the nation, it became glaringly obvious that relying on the private market to fix the crisis was a deadly mistake. The short-term mortgage had brought the American economy to its knees. If the country was going to survive, the entire concept of how human beings borrowed money for shelter had to be completely reinvented from the ground up. Something radical had to happen, and it was going to require an unprecedented level of government intervention. When Franklin D. Roosevelt took the oath of office in March of 1933, he inherited a country that was economically bleeding to death. FDR knew that to save the American economy, he had to stop the hemorrhaging in the housing market. People who are terrified of losing their shelter do not spend money, and a consumer economy simply cannot function without consumer spending. FDR and his brain trust of economic advisors engineered a massive, unprecedented federal intervention that would change the trajectory of American wealth forever. In 1933, as part of the sweeping New Deal legislation, Congress created the Homeowners Loan Corporation, or HOLC. This is the exact moment the system shifted. This was a radical, almost socialist idea at the time. The federal government stepped in and started buying up these toxic, defaulting mortgages directly from the failing private banks. They essentially bailed out the lenders, but more importantly, they rescued the homeowners. When the government bought your mortgage from the bank, they tore up that predatory 5-year balloon contract. In its place, the government issued a brand new type of loan. First, they stretched the repayment period out to 15 years, which dramatically lowered the monthly payment. But crucially, they made the loan amortizing. This is the magic word that changed everything. Amortization meant that every single monthly payment actually paid down a little bit of the principal debt, not just the interest. Over the course of 15 years, your debt slowly shrank until it hit zero. By the time the loan was done, you actually owned the house free and clear. There was no terrifying balloon payment waiting to destroy you at the end. HOLC was a massive logistical undertaking. The government had to hire thousands of appraisers to fan out across the country and value the homes they were saving. By the time the program closed, HOLC had received nearly 1.9 million applications and successfully refinanced over 800,000 mortgages. They literally saved 1 out of every 10 owner-occupied homes in urban America from foreclosure. But FDR didn't stop there. HOLC was a temporary emergency rescue mission. To build a permanent system that would encourage banks to start lending again, the administration created the Federal Housing Administration, the FHA, in 1934. Here is the part most people miss about the FHA. The FHA did not lend money directly to citizens. Instead, it operated as a giant insurance company for the banks. The government sat down with the private banking sector and made them a deal they couldn't refuse. The federal government told the banks, if you give people these new, safe, long-term, amortizing mortgages, and the borrower somehow defaults, the federal government will pay you back. We will absorb the risk. With the federal government suddenly absorbing all the danger, the banks felt incredibly generous. Because they couldn't lose money, they were willing to fundamentally alter the terms of borrowing. The 15-year term introduced by HOLC was quickly stretched to 20 years, and eventually, the legendary 30-year fixed-rate mortgage was born. Down payment requirements plummeted. You no longer needed 50% in cash. The FHA insured loans with down payments as low as 10 to 20%. Overnight, the rules of gravity in the housing market were rewritten. A young couple could now save up a modest sum, buy a home, and lock in a low, predictable monthly payment for the next 30 years. The sheer scale of this intervention is hard to overstate. Before the FHA, a mortgage was a handshake deal with a local banker who knew your father. After the FHA, a mortgage was a standardized, federally backed financial instrument that could be packaged, insured, and regulated by Washington. FDR essentially nationalized the concept of mortgage risk. It was a brilliant, desperately needed solution to the greatest crisis of the 20th century. It stabilized the nation and gave millions of terrified families the ability to finally sleep at night without fearing the sheriff's knock. Yet, by inviting the federal government into the housing market, Americans unwittingly handed over immense power to federal planners. These planners now had the authority to reshape the demographic landscape of American cities with the stroke of a pen. The creation of this specific financial product is arguably the single most impactful piece of social engineering in American history. It transformed homeownership from an exclusive privilege of the rich into a mass consumer product. It effectively birthed the modern American middle class. But this new system required an entirely new bureaucracy to function. To ensure these loans, the FHA had to determine which loans were safe and which were risky. They needed a standardized way to evaluate not just the houses, but the neighborhoods, and most importantly, the people living in them. And it was in this bureaucratic evaluation process that the government embedded a deeply sinister flaw into the foundation of the new American dream. The 30-year mortgage was about to trigger an economic boom the likes of which the world had never seen, but it was going to do so by actively deciding who was allowed to participate and who was explicitly locked out. The invention of the 30-year mortgage revolutionized American society in ways FDR couldn't have fully predicted. Following World War II, returning veterans used these new government-backed loans, specifically through the GI Bill, to trigger the greatest housing boom in human history. Millions of families fled the crowded industrial cities to buy brand-new, mass-produced homes in the rapidly expanding suburbs. Places like Levittown, New York, sprang up overnight. The national homeownership rate skyrocketed from that stubborn 40% in the 1920s to over 60% by the 1960s. For the first time in history, average working-class families could build generational wealth simply by paying their monthly mortgage. But this incredible wealth-building machine was deliberately designed with a dark, exclusionary shadow. Because the FHA was insuring these 30-year loans, they got to dictate exactly who received them. In 1935, the FHA released a highly detailed underwriting manual that provided strict guidelines to appraisers. This manual explicitly stated that incompatible racial groups should not be permitted to live in the same communities. To enforce this, government surveyors took literal red pens and drew lines on city maps, outlining minority and immigrant neighborhoods. They labeled these areas as hazardous or Type D zones and refused to insure any long-term mortgages within those red lines. This devastating practice, known as redlining, effectively locked millions of Black Americans and other minorities entirely out of the 30-year mortgage revolution. While white middle-class families were moving to the suburbs, locking in 30-year fixed rates, building massive equity, and passing that wealth down to their children, minority families were deliberately trapped in declining urban centers. Because they couldn't get FHA-backed loans, they were forced to rely on predatory contract loans, which looked horrifyingly similar to the old 1920s balloon mortgages. High interest, no equity building, and instant eviction for a single missed payment. The racial wealth gap you see in America today wasn't an accident of the free market. It was heavily subsidized and meticulously engineered by the exact same government policies that created the modern middle class. The 30-year mortgage was indeed a miracle of financial engineering, but it was a strictly segregated miracle. Fast forward to the 2020s, and the 30-year fixed-rate mortgage has become the absolute bedrock of the American economy. It is so ubiquitous that we view it as a fundamental right, but the landscape has shifted drastically since the 1950s. Today, housing prices have vastly outpaced wage growth. The 30-year mortgage, which was originally designed to make housing affordable, has ironically helped drive housing prices into the stratosphere. Because banks can stretch your payments over 30 years, they can lend you massively more money. And because everyone has access to massive amounts of borrowed money, home sellers can demand astronomical prices. We have created a system heavily reliant on debt. In 2023, total mortgage debt in the United States surpassed $12 trillion. The very instrument designed to liberate Americans from the terror of short-term loans has slowly transformed into a requirement for entry into society. You no longer buy a house, you buy a massive 30-year debt obligation just to secure a place to live. The financial sector, which was bailed out and stabilized by the government in the 1930s, now reaps trillions in steady interest payments from generations of homeowners. We solved the crisis of the 1930s, but in doing so, we built an entire economy entirely dependent on continuous, heavily leveraged borrowing. Think about how normalized this has become. When you are approved for a $400,000 mortgage at a standard interest rate today, you don't just pay back the $400,000. Over the 30-year lifespan of that loan, you will pay hundreds of thousands of dollars in interest alone. You end up buying the house for yourself and essentially buying a second house for the bank. Yet, we celebrate this transaction. We throw housewarming parties and post pictures of the keys on social media, completely ignoring the fact that we have just chained ourselves to a financial institution for the most productive decades of our lives. The government intervention that saved the housing market also created an environment where debt is no longer a moral failing. It is a mandatory lifestyle. Today, the 30-year fixed-rate mortgage is so deeply embedded in our culture that we rarely stop to question what it actually does to us as individuals and as a society. We celebrate signing that mountain of paperwork as a victory. But think about the cold, hard math. The system that was brilliantly invented to save Americans from short-term, predatory debt traps essentially replaced that immediate terror with a permanent, lifelong debt obligation. It subtly turned citizens into predictable, obedient workers who cannot afford to take massive risks, strike out on wild entrepreneurial ventures, or challenge the status quo, precisely because they have a 30-year payment hanging over their heads every single month. The government intervention of the 1930s was exactly like a life preserver thrown into the freezing, chaotic waters of the Great Depression. It saved millions of families from drowning in a sea of foreclosures. But as the decades passed, we never took that life preserver off. It absorbed water. It grew incredibly heavy. And today, for many working Americans, that original life preserver has slowly morphed into a massive anchor, tying us to the financial system for the vast majority of our adult lives. It forces us to ask a difficult, unsettling question about the true nature of the modern economy. Is the American dream truly about owning a piece of land and a home of your own, or is it simply the privilege of mortgaging your future to a bank? Are we really homeowners, or are we just glorified, long-term tenants of the financial institutions that hold our deeds? The 30-year mortgage allowed millions to build wealth, but it also fundamentally redefined freedom. It traded the terrifying uncertainty of the 1920s for the comfortable, predictable servitude of the 21st century. When you sign your name on that dotted line, you are participating in a financial experiment born from sheer desperation nearly a century ago. You are stepping into a system designed to keep the economy moving, the banks profitable, and the citizens deeply invested in the status quo. If you found yourself rethinking everything you thought you knew about buying a house and the American dream, you are exactly in the right place. History isn't just a dusty collection of dates. It is the blueprint of the financial traps and systems we navigate every single day. Hit that subscribe button and turn on notifications so you never miss a deep dive into the hidden machinery controlling our world. Leave a comment down below. Do you think the 30-year mortgage is a blessing for the middle class, or just a sophisticated, lifelong debt trap? I'd love to hear your thoughts. Until next time, keep questioning the narrative.